certainly on Twitter that I see. And I'm going to be kind of referring to them here as we go through this episode. But I want to kind of start off with what your thoughts are on financial conditions, the Fed's tightening cycle, and just what global central banks are doing in general. So, Jeroen, you kind of kicked off this last newsletter that you sent to me before this with just your own thoughts about where we are in terms of the tightening cycle and kind of the narrative that is forming around interest rates. So you just walk us through kind of what's on this chart and what your view is on the Fed and central banks globally.
Sure, and it's all very nice to see you both and to have this conversation with you. I'm very excited to be here. But so this is an interesting Fed cycle, or it's turning into one, because I think a year ago we all knew that the pandemic would run its course and the economy would kind of return to normal, and that the 0% Fed policy, not only for the Fed but around the world, would no longer be justified, and certainly the 120 billion in asset purchases per month would no longer be justified. But at that point, the expected curve for the Fed to normalize policy was very gradual, very smooth. And basically, if you looked at the Eurodollar curve or the Fed funds curve, or even in this chart here where you see the number of expected rate hikes by various points in time for this year, the curve was very smooth back then, a very gradual return to normal, which would be around 2.5%, which is where the median dot is for the long-term view of the Fed. Or if you take R star, the natural rate, which I think is around 0.5% or so, you add 2% inflation, you get to 2.5. So a year ago, that was the curve. Obviously, a lot has changed. Inflation has proven to be a lot more stubborn and hot than I think a lot of people expected, certainly at the Fed, but I think generally in the marketplace as well. And of course, we got last week's number coming in hot again at 7.5%. And so since the December period, when we got the minutes from the previous FOMC meeting, and then the December meeting, and then various further speeches by the Fed, the path has been accelerated quite aggressively, and now actually the expectation is that there will be 6.5 rate hikes this year. Obviously, it'll be 6 or 7, but that's what the market is pricing in, and so that kind of takes us out of the kind of the 2015 to 18 analog, which is what I had been looking at in terms of a gradual, smooth return to normal without any real urgency. So the market is doing a lot of the heavy lifting for the Fed. And I think the glass half full interpretation, therefore, would be that the Fed really just has to do a lot of talking. But if the markets are doing the work for it, when in a year or two from now, the Fed won't really have to go much above 2. The alternative interpretation, of course, is more of a glass, half empty view, which is that the market thinks the Fed is going to have to chase inflation until it breaks something. And then we get a 2018 scenario during which the market, of course, fell 20% fairly quickly. And that forced the Fed to pivot to a more dovish outlook. My guess is that it's going to be the former and not the latter, but it certainly is a conundrum that even with all the hot inflation numbers and all the talk from the Fed about more, faster, sooner, that the market still expects this hiking cycle to end below neutral. Even if inflation comes back down to 3 or 4%, which I think is likely over the next couple of years, the Fed would not even end this cycle at a neutral point. And that seems inconsistent with the kind of inflation numbers that we're seeing.
And I really love this chart because it sort of has the time period of my entire career on it. It's 1992 is about the period that I started college, and 1998, the first crisis there, was the time I started working. So I vividly remember all these periods in time, and especially the rate movement. So what I like about this chart is that you see the three crises so very well in the chart. So the 2000 internet bubble, and the Fed had to accommodate that by lowering the interest rates, of course, which and it's much lower than the actual 10 years rate. It's also a short maturity rate, of course, but you can obviously see the difference between the Fed rate and the 10-year rate being very high after that 2000 internet bubble. And the same happened after the global financial crisis in 2008, where rates dropped again to almost zero. And then right now, after March 2020, they dropped again. And but it's a kind of a dual thing, because after each crash, so for example, look at the global financial crisis in 2008. They bring the Fed rate down, but it's also after a period where they try to raise the interest rates again. So in 2004 to 6, you see, they try to raise the interest rate, then something happens. I think it's more the latter. It used to be more of the former, but and also, with respect to the earlier chart, I think the yield curve, of course, is an X-ray of the market. How one of the deepest markets in the world, in fact, the deepest market in the world, the interest rates markets are looking at things. And the 2-year domain, of course, is the bank domain, because banks have liabilities that are typically saving accounts in the 2-year maturity domain. And 10 to 30 years is, of course, pension funds, mortgages. So that's an entirely different group or asset looking at the market. And so the yield curve gives you all those perspective in one line over time, also dynamically. So it's great. And sometimes it goes wrong indeed when you go negative. That almost always predicts a recession. However, lately things have changed a bit. So it used to be that the market participants, the banks, the pension funds, were giving their votes, if you will, by buying bonds, and you could read in the yield curve how they thought about the future. But right now, I guess. But maybe things are different in Europe than in the US. So I'm very interested in Jurian's perspective as well. Right now in Europe, the central bank is one of the biggest buyers. In fact, they're in the whisper to be the only buyer, the one buyer. Those are the terms that you hear. So I guess even mortgages, 50% of all the mortgages are bought by the central bank. So wow. In that way, the central banks right now have very much control, not only over the short-term durations and their own Fed funds rates, but also over the 2-year, 10-year, and 30-year rates. So I guess if we go negative now, it's more like a little mistake or something of two departments not talking to each other.